Good afternoon, Elavace investors. It's Mitchell Walsh, Sales Director at Elavace. Thank you very much for joining us for our weekly educational video on the 10 important steps and beginner's guide to property investment. So I'm going to cover a number of different topics today. Firstly, I want to cover the first things that you should be looking for when looking for your first property investment. I'm also going to cover a number of different topics like what makes the best investment, the different types of locations, and the type of incentives that are available to investors at this current time. Now, when purchasing your first investment property, it can be quite a daunting and scary experience. At the end of the day, you're looking for something that you're putting your life savings into, so it's extremely important that you choose the right investment opportunity for you. So the first thing that I would recommend that you do is speak to an expert or somebody that has done this before. So whether this be a reputable investment property company, or whether this be a friend or family member, or just somebody that you know that has been through the experience before. The second thing to have in mind is your budget. Have a budget in mind and stick to that budget. Don't ever allow anybody to push you to overstretch yourself. The bottom line is it's important that you are comfortable with every aspect of the property investment, and there's nothing more important than the budget of which you have available to invest. Number 3, which is probably the most important aspect of property investment, and that is conduct your due diligence. Again, don't ever be pressured into making a quick decision. You need to ensure that you have all the information before you are comfortable in making a calculated decision. Now, this will be from looking into the development itself, looking into the developer and the proven track record, and really conducting all of these things together to get a real understanding of just how safe the opportunity is. Number 4 is location. Now, it's an old cliche, but location could not be more important. It's important to do research in the area that you are investing in, ensure that there is a proven track record of both security, growth, but more importantly, rental demand. Remember, just a couple of months of a void period when it comes to renting out your property can significantly affect your return on investment. Number 5, are you going to be able to manage this property investment yourself? And you have to remember, renting out a property can sometimes take up a lot of time, and in some areas can actually be a full-time role. So you need to distinguish whether it's better to take care of the investment yourself or to look for an external management company to manage the property for you, find your tenant, and take care of the general upkeep of your property. Number 6, capital appreciation. Now, capital appreciation is an extremely important aspect of your overall return on investment. Now, when you're coming back to my previous point of location, it's extremely important to look into the area, look at the regeneration opportunities that are going on, the money that's being pumped in, and more importantly, is there a likelihood that there will be a growth in the area? Now, this can be highlighted by things like rental demand, occupancy rates in the area, and it's extremely important to look at all of these points before you make your decision, as this will be one of the key points in making the opportunity a successful investment or something that doesn't yield the same type of return that you were expecting. Number 7, is the opportunity too good to be true? Now, quite often there will be certain developer incentives that are available that do normally seem too good to be true. And the simple reason for that is they normally are. So when looking at developer incentives such as long rental insurance periods, you need to have a look into the developer and see whether they have a track record in providing that rental assurance, and do they have the capabilities to continue to do so. Ensure that you look into all aspects of the incentives that are available and make the decision and ask the question, is this too good to be true? Number 8 is your rental yield. Now, this may seem like a foreign terminology if you are not a property investor, but it's actually quite simple. You simply take your annual rental amount and divide that by the property value. And you need to take into consideration when working this out things like your ground rent, your service charge, your management costs, and any other fees that are taken into consideration when purchasing the property. Now, an average to comfortable amount will be the 5 to 7% net return mark. Anything below that, you need to consider, is this investment opportunity worth it for you? And anything above that, you need to consider whether this is realistic and whether the overall investment, including your appreciation potential, is available to you and is likely to be achievable. Number 9, target tenant demographic. Now, this is one of the things that you need to consider when purchasing a property. Are you going to go for the traditional long-term AST route, or are you going to go down the more modern route of short-term lets? Now, both of these are perfectly good investment strategies, but you have to consider which option works for you. Both of them have their upsides and their downsides. Your typical AST long-term tenant route is perfect for a steady income that you don't want to put much work into and achieve a solid rental return. Now, the short-term route can give you a much higher return on investment, but you have to consider things is you will have additional work to do if you don't have the right management agent, the wear and tear on your property, and in the current climate, is it going to be sustainable to rent your property out on a short-term basis? Now, last but certainly not least is number 10. Which investment model works for you? Now, you have 3 different types of property investment options in the current climate. Number 1, which is a completed investment property, which is normally already tenanted, but you will not normally see the same type of a capital appreciation potential that you will see in off-plan property. However, this will give you an immediate return on investment and minimize any risk for your more cautious buyers. Number 2 is purpose-built student accommodation, or PBSA schemes. Now, purpose-built student accommodation has proven to be an extremely lucrative investment that is only available to cash investors. However, in recent times, we have seen that this has changed slightly, and while there has been an extremely high supply, there is a relatively low demand due to the current climate. So this is one of the things that you need to consider when weighing up your options. Number 3 is your off-plan residential property investment. Now, in my opinion, this is the most lucrative option for investors that want to maximize on their potential return on investment. And the reason being is you are purchasing a property that is normally around 10 to 15% below market value. This goes hand in hand with maximizing your rental yield. As you are buying at a reduced property price, the rental return divided by that property value is normally much higher than the finished article. Now, it is important that you conduct your due diligence, that the development is secure and is with a reputable developer to minimize any potential risk of the development not being finished. Now, thank you very much for joining me here today. I really hope the information that I've given you has been helpful. If you do require any further information, or you just want a general chat or some advice, please don't hesitate to get in contact on the telephone information below. Now, join us back here next week for our latest advice and investment piece for our Elavace investors.